Hi, everyone. Welcome back to Protocol Lab's Research Seminar Series. Today, we have Associate Professor Alfred Lehar of the University of Calgary. Dr. Lehar received both his undergraduate and doctorate degrees from the University of Vienna. Prior to joining the University of Calgary in 2005, he held positions at the University of British Columbia and the University of Vienna as well. Dr. Lehar is currently researching mining fees and price differentials in Bitcoin markets, decentralized exchanges, renegotiations, systemic risk in financial networks, and the interaction between product and financial markets. Today, Alfred will be giving a talk about his research around decentralized exchanges. We also have the co-author, Christine Parler, here from Berkeley. And then right now, I just want to give it away to you, Alfred. Thanks again for joining us today, and we're excited for hearing about your research. So I'll let you take it from here.
Thank you so much, and thank you so much for having us here. So it's really a great pleasure to present this this research here in an industry setting as well. And I'm very much looking forward to your comments. So as you said, this is joint work with Christine Parler from UC Berkeley. So most of the modern exchanges, if you look at how they're organized, like the New York Stock Exchange or places like that, they're operated as an open electronic limit order book. And the reason is that this is generally viewed as the most efficient way to provide liquidity in markets. But somehow the implicit key assumption that underlies this conclusion is that these liquidity providers are perfectly competitive. And so if they're perfectly competitive, they obtain zero profit and try to provide liquidity in the best possible way. But this is not really how this works in practice. So if you've seen the Hummingbird Project movie, for example, about high frequency trading, there's huge investments in this space. People pay a lot to co-locate their trading servers next to the exchange server. And so there is this big investment in high frequency trading just to carve out a competitive niche and to extract some rents, to become somehow a monopolist. So to somehow do better than the others. And this is really one of the problems with these central limit order book markets, we believe. And we want to compare a setting where we look at limit order markets with this idea in mind that you can invest in some competitive niche to try to get ahead of your competitive liquidity providers, and compare that to liquidity provision in liquidity pools, just as you see them on a lot of these exchanges in DeFi, like Uniswap, SushiSwap, or many others that are out there. So what is our main finding? We find that liquidity pools can dominate these limit order markets when there's many uninformed traders, so people that just trade for exogenous reasons and don't trade because prices have changed, or they have some information that others don't have. If prices don't move by much, and if the incentives to invest in this high frequency trading are strong. So what drives these liquidity pools, or what else can we see? We can see that these liquidity pools track limit order market prices pretty well, and they have a lower price impact. So one complaint that you often get from institutional investors, like mutual funds who want to trade large quantities of stocks, is they look at the market and they see that there is a lot of liquidity posted. But that liquidity then, when they actually want to trade, suddenly evaporates, and they will see that their order actually moves prices a lot. So there's a whole industry that tries to come up with countermeasures to that, to slice your large order up in tiny pieces and spread them out throughout the day. And this is kind of a wasteful investment. So we find that these liquidity pools can actually have a lower price impact for these institutional traders, and they also have lower variation in price impact. So institutional investors who want to trade in these liquidity pools know pretty much what they are getting into. So what we have in mind for our theory model, and what we also look at the data, is Uniswap, first and largest decentralized finance swap facility that is part of DeFi. trading volume is pretty big and had stellar growth. So they trade over $3 billion a day, and the posted liquidity, at least at the time of the writing, was $7.5 billion. So this is a pretty big exchange, but Uniswap is not just one monolithic system. It actually consists of tens of thousands of individual liquidity pools, and where you can trade one token against another token. And the beautiful thing is that everybody can be a liquidity provider on Uniswap. So I, for example, am a liquidity provider on Uniswap. I could not be a liquidity provider on the New York Stock Exchange because it would just be too complicated. I could not have the investment in all the technology. I would not have a computer that's co-located with the exchange computer. So I could not afford that, but I can afford to be a liquidity provider in Uniswap because it's pretty straightforward. So how does trading work? I'm sure the audience in this group is pretty familiar with how DeFi works, but you send a token A to the smart contract that governs the liquidity pool, and then you receive token B in return. And so this way we can, in a non-custodial way, trade with the Uniswap liquidity pool. So if you want to think about this from an economic perspective on how is a limit order market different from the liquidity pool, we come up with a simple stylized model. And we come up with a simple model that we can track both in the limit order market and in the liquidity pool. So we have a simple asset that has a current value P0, and with some probability alpha, an innovation comes around, and so some news comes out that we can learn, and that changes the way we perceive the price of that asset. So the price of that asset can then either go up to P0 plus sigma or down to P0 minus sigma. So sigma is kind of that spread on how much we learn when a news event arrives, and alpha tells us how often do these news events arise and come up. And so if there is no news event with one probability 1 minus alpha, then the price just stays the same. So we have three types of agents in this model. So the first one is a liquidity trader, and this is just somebody who trades for some exogenous motive. So maybe you just want to sell your crypto because you want to buy a house or something else, and there is no particular information-based reason why this trader trades. So they trade a quantity Q, and they arrive whenever there is no innovation in price. So the price stays the same. If there is some innovation in price, that we learn something new, that I don't know, El Salvador allows cryptocurrencies, then prices could go up, or some tweet by somebody drives prices up or down, then the arbitrageur comes in and he learns about that innovation and trades on it. The third important provider here, or agent in this game, is the liquidity provider, and they provide the liquidity, so they are the counterparty for the people who want to trade, for the liquidity trader and the arbitrageur. And the key assumption here is that they are unaware of which type of trader they face. So when they see somebody wants to buy from them, they don't know, is this a liquidity trader? So does that mean that the price has not changed? Or is this, if somebody wants to trade with me, is this an arbitrageur who has learned something that I don't know yet and wants to trade on that information? So obviously, you would quote very different prices if you have a liquidity trader, if you face an arbitrageur, but because you don't know, you just have to quote some average price. So how does the limit order market, how do we think about a limit order market? How does that work? So the usual assumption is that we have these competitive liquidity providers. So they don't know if somebody wants to buy from them, they don't know, is this a liquidity trader or is this an arbitrageur? So they just set an average price. If it was a liquidity trader, the price would not change. If this was an arbitrageur, the price would change to P plus sigma. And so they sell at an average price, so they make money from selling to the liquidity trader, and they lose from trading with the arbitrageur. And so ideally they break even on average, but they just break even. So for general, the spreads in this kind of setting are narrow, but the liquidity providers don't make any money. So therefore, there is this huge investment to invest in a technology that gives you some kind of competitive edge, to create some kind of market power. So we can think about that as high frequency trading, to learn if some institutional trader like a mutual fund is placing a large order that would move the price, to learn information faster than others, those kind of ideas. So if they are successful in carving out that competitive niche, they can become a monopolist liquidity provider. So as a monopolist, if you know that you're the only liquidity provider or that you have this competitive edge, you charge, of course, as much as you can, and you charge a very high spread to any trader that arrives, and that just allows you to make some extra money. The technology is wasteful and costly, so there's not really anything that society gains from investments in this high frequency trading technology. So the second kind of market that we contrast the limit order to is this liquidity pools. So a lot of you have probably used Uniswap or something similar before. So let me just briefly recap how this kind of market works. So suppose there's a pool that has some amount of ETH and some amount of token in there, and the exchange rate is just set by the ratio of the two. If you want to trade against that liquidity pool, you have to pay a fixed proportional fee. And the beautiful thing about these markets is that the price impact is deterministic and is known ahead of time. So the prices are determined in such a way that whenever you trade a certain amount of delta E, so if you add some ETH to the pool and you withdraw some tokens from the pool, the new point where you end up has to be the same. If you multiply those two quantities together, they are constant, and this is what's called the bonding curve market. So graphical illustration of this idea is that you start out, so this equation that we had before creates this bonding curve. So if we start out at this point here, E0, T0, and somebody adds maybe some tokens to the pool, then we increase the balance of the token, and how much ETH does the trader get in return for sending these tokens to the liquidity pool? We can draw that graphically and see that here as the difference along the y-axis. That will give us the amount of ETH that the trader gets in return for the amount of token that she sends to the smart contract. So how do we see that in the context of our model? These liquidity providers obviously have a fee income. They earn a fee, which we call tau per trade. And these liquidity providers could now face two types of traders. So this could be, again, the liquidity trader, where there's no change in the true price. So what happens in this case? Well, if the liquidity trader comes, they push the price from E0, T0 to E1, T1. So the price is out of equilibrium because the true price has not changed. So what happens next is that an arbitrageur will come in and push the price right back where we started. So somebody sees, hey, this pool is is not priced correctly, so I'll just push the price back to where it was before. And so this is somehow related to this idea of impermanent loss that is often floated in the context of these liquidity pools. So for the liquidity providers, nothing bad has happened, right? So you moved from one point to another point, and then you moved back to where you started from. So nothing has changed, except that you collect 2 times the fee, which is actually great for the liquidity providers. But what is not so great for the liquidity providers is if the true price changes. So the pool quotes some price P0 and assume that this innovation comes around in price, and the two price changes either by this amount sigma. So what happens then is that the price that the pool quotes is stale, and some arbitrageur will come along and take advantage of this mispricing. So the pool gets picked off, and because this arbitrateur trades on a stale price, and the liquidity providers lose out because they sell the token not at its true value, but at a price that was stale. We try to come up with, to relate our findings to the data and come up with some empirical estimates. And so to do that, we collect some data on Uniswap. So we collect all Uniswap V1 and V2 liquidity pools from the factory contracts, transactions on the Ethereum blockchain, and we collect 36,900 individual liquidity pools. Most of them are V2 pools, and some of them are V1 pools. So we have about 47 million transactions on Uniswap from the beginning in 2018 until May 2021. So there are about 1 million injections of liquidity into these trading pools. There's some withdrawals of liquidity from the pool, but most of the transactions are actually trades of tokens. Now there's some complex transactions or flash swaps in there as well, but most of the transactions are trades of tokens. So this is a little summary of these largest exchanges. We see that, so these are daily volumes. We see that some of these pools trade quite a lot, actually. And obviously, V2 exchanges are much larger, both in number of transactions and in volume, and also in the size of the pool than the V1 exchanges. What we also see from this kind of little summary table is that the most popular exchanges are the ones that trade against some kind of US dollar stable coin. So we have here Tether, USDC, DAI are the top 3 exchanges here on Uniswap V2. And another one that's very big, at least in dollar terms, is FEI, which is another US dollar stable coin. So this graph here shows you the 50 largest liquidity pools on Uniswap. And whenever there is a pool between 2 tokens, there is a line connecting those 2 token tickers here in this graph. And the thickness of the line is proportional to the trading volume in these in this liquidity pool that is defined by these 2 tokens. So one thing we see here is that, in line with what I showed you before, that the thickest lines are to the US dollar stable coins. And the other thing we see is that wrapped ETH is really the center piece of that network. So all the tokens pretty much trade against wrapped ETH. Some of the tokens trade also against the US dollar stable coins directly. So we see here, for example, I don't know, the Lend token trading against Theta here in the pool. There's some we see from these lines emanating from USDC. So there's quite a few tokens trading against that stable coin, but there's not so many tokens trading directly against each other. Most of the trading, most of the liquidity pools run through wrapped ETH. So this is kind of the real centerpiece of this. And interestingly, the network structure we see here is what's called a core periphery network structure. And that's very typical for a lot of financial networks. So if you look at interbank lending, for example, we also see a very, very similar network structure. We have a few banks that are heavily connected in the middle, and then there's a lot of banks on the periphery that really are not connected with each other, but trade through this central bank in the middle. So this graph shows you some data on trading volume. What you can barely see here is V1 at the beginning. There's slight blue peaks here at the very early stages. So trading volume was relatively small compared to when V2 arrived. So the orange part is the trading volume of in V2 exchanges direct to wrapped ETH, which is the majority of the volume that we see here. So the red part is trading volume against other tokens that is not as nearly as much as the trading against Rapid. We also see these spikes here. Actually had to cut off this graph at some point in time because there is a spike here that goes way higher than the graph would show, because there have been these flash loans and attacks that create huge volume on Uniswap for a certain day. There's of course a lot of interesting curious transactions in the data. So one thing we noticed was that some tokens have copycat tokens of prominent tokens. So if you, for example, USDC, there is quite a few tokens that are named USDC, but they are not the real thing. They're a fraud token. Sometimes there's even artificial trading in these tokens going on, so that somebody who is not very careful might perhaps buy this token, which is just a fraud token, because there's no protection of names, obviously, in Ethereum. There's some interesting spikes in there too. So on October 26, for example, there was a $2.1 billion attack on Harvest Finance. And very often in these type of oracle attacks, traders trade large quantities to purposely move the price along the bonding curve for a short period of time, so that other contracts that use Uniswap as a price oracle then do something that the attacker can exploit in a certain way. So based on this temporarily manipulated price, these attackers collect a huge payout from Harvest Finance on that day. There's another large trade, for example, in Unibomb tokens, where somebody swapped huge amounts of Unibomb, and the reason there was that Unibomb is a deflationary token. It burns certain fraction on each trade, and so if you trade it back and forth many times, then the supply goes down and the price increases, and then somebody took advantage of this fact and bought a lot of Unibomb tokens and then reduced the price dramatically. So a lot of very creative ways to extract money can be seen in the data, and that causes a lot of these spikes that we see in trading volume. So let us now focus a little bit on what drives these the liquidity provision in Uniswap. How is it different than in limit order markets? And I want to show you some pictures to compare exchanges at the end. So the first thing we want to think about is what drives actually the optimal size of these liquidity pools. So these liquidity providers have revenues and costs. So the revenues are the trading fees. So whenever somebody trades, either liquidity provider or an informed trader, they collect a fee, and those fees have to offset at least the losses from quoting stale prices. So when the pool quotes a price and the price is changed afterwards, then the pool gets picked off. So in equilibrium, and like we like to think in economics, these revenues from the fees have to balance out with the losses that we quote on the stale prices. So these fee revenues get shared amongst all the liquidity providers. So in a way, we can think about this is that if these losses from quoting stale prices increase, then the pool has to shrink. The pool has to shrink to discourage the informed trader to trade, and also to increase the revenue per unit of liquidity provided. So if you all these trading fees, if the pool shrinks in size, get shared amongst fewer people, so the fee revenue for each liquidity provider goes up, and so we end up again in an equilibrium where the fee revenue equals the losses from quoting stale prices. So there's kind of two predictions from this from the model that we then want to confirm in the data, is that these when these losses could go up for two reasons. One is that this innovation changes. So whenever you learn something new about prices, that this innovation has more dramatic effects, that either prices go up a lot or prices go down a lot. And so in our little model, we predict that whenever that happens, the equilibrium size of the pool goes down. The other thing we model is we look at is the incidence of informed trading. So this is what's measured with alpha. So how often does news arrive, and how much that gives us a measure of how much of the trading is informed versus uninformed. And we see again that if there's more of these arbitrageurs picking off the liquidity pool, then we see that the optimal size of the liquidity pool goes down. So to take that to the data, we try to come up with some measurements. So we look at the optimal size of the pool as a function of the price volatility. And the price volatility is in a way related to this innovation. If the innovation, if the prices go up a lot or down a lot, whenever there was some news announcements. So when we should see that more happening when the price innovations are larger, volatility is larger, we should see that the size of the pool shrinks, and we see that confirmed in the data. So in this regression analysis, we see that when volatility increases, optimal pool size goes down. The second prediction is kind of harder to measure because we don't really have very good information of uninformed trading. So what we saw before was that whenever these news arrive more often and more of these arbitrageurs trade, we should expect the pool size to shrink. So here we take the other view and say, well, if there's less of this informed trading, so more uninformed trading, then we should see the pool size to increase. So we try to come up with 3 potential measures of this uninformed trading. So one is just in general trading volume. So if we think that news arrive exogenously, that there's a certain just amount of news that hits the market every day, and is not driven by what people do in the market. So then more trading volume means that it cannot be from the trading on news because that's kind of given. So if there's extra trading volume, that must come from the uninformed traders, the liquidity traders, people who just trade for other reasons. So we therefore would argue that if you have more trading volume, that correlates with an increase in uninformed trading, and then the pool sizes should be larger, and we see that in the data. The second measure we look at is the number of trades, again, because the informed trader, if you trade on news, you trade, but any extra trades beyond that, beyond the amount of news that comes out, any extra amount beyond that comes from these uninformed traders. So larger number of trades means that there is more uninformed trading, which also means that the size of the pool should be larger, and we do find that in the data as well. So the last measure is what we call reversals. And so this is whenever an uninformed trader trades, pushes the price away from the equilibrium price, and then an arbitrageur comes in and pushes the price back. So these are trades where somebody places an order, moves the price by a certain amount, and then immediately after, within the next 2 blocks, somebody comes in and pushes the price back to where it was before. And so we look at the number of these reversals in the trading pattern on Uniswap, and we find that the more of these reversals we see, the larger the pool size. And this is, again, our measure of being an uninformed trader. So another thing we see is that we look at what happens with the stability of the liquidity provision. So what we see in traditional financial markets is that there is a lot of limit orders are being submitted and canceled, and this happens very fast. So this is what's called flickering quotes. in this high frequency trading literature, where there's a lot of orders coming in that are immediately canceled. So one example is that I found cited in a study was that Protective Life Corp put in 21,000 messages in 10 seconds. And so that was 21,000 orders, cancel order, order, cancel order, and that resulted in exactly one trade. So we don't see that so much on Uniswap. We don't see that people put in liquidity, withdraw liquidity very quickly. So first of all, only 1.1% of the sample are liquidity withdrawals. So that's a fairly low amount. And when we look at events in the data where the same address added and withdrew liquidity within, say, 50 blocks, we only find 1,800 observations that do that. And the median size is $140. So these are not huge things. This is probably where just somebody made a liquidity pool and tested out, oh, how does this work? Let's try that. We only have 18 observations in our sample where the deposit and withdrawal was over $1,000 and was within 5 blocks. So these would be the cases where somebody might inject and withdraw liquidity strategically, but these are 18 observations out of 47 million. So this is not really a thing, it seems, in these liquidity pools. So here is an example for one day. What happened to liquidity provision around May 19th. So that was a pretty bad day for Ethereum. The price of Ethereum against the dollar dropped by 41%. Just to put that in perspective, on the worst day for the S&P 500, which was on October 1987, the S&P index dropped by 20.5%, which is exactly half as much as the price drop we saw here. And people still talk about the 87 crash. And so that was a very traumatic experience for the stock market. So this was twice as much of a drop in price as we saw back then. So the orange area shows you the price chart of Ethereum on a very high frequency basis. And we see that the price here drops over time in a couple of hours to this low point. What is the blue line is the liquidity, the change in the liquidity provision for the large US dollar ETH liquidity pools on Uniswap. And what we see here is that, so here's the baseline is 0. So we see that up to a pretty large part, liquidity provision does not change. And even if you look here at the very lowest point in Uniswap, in the ETH price, when it dropped by a lot, when we compare that here, we see that about 2% of the liquidity has been withdrawn from the ETH US dollar stablecoin pools at that point in time, which is really tiny. Overall, we still see that in this kind of whole panic, liquidity has been withdrawn, but only after the ETH price has recovered. And a total of about 17% of the liquidity has been withdrawn, which is not that much, actually. So we would argue that this is at least consistent with the idea that liquidity provision on these pools is actually quite stable. And so traders who want to trade in these crisis situations do find the liquidity there so that they can actually trade with somebody and get sell their tokens. So when we want to look at how does the liquidity pool compare with the limit order market, we want to show you a few things here. So first of all, the liquidity pools actually manage to track the market prices pretty well, and that are on the limit order market. What our theory model predicts and what we want to confirm in the data is that two important facts for institutional traders, if you want to trade a lot, that you have a lower price impact in these liquidity pools and that you have a lower variation of that price impact. So the price impact becomes more predictable and stable so that you can trade if you need to trade and don't face a huge price impact. So to do our exercise, we collect minute by minute interval data from Binance, which is a limit order market that is similar organized in the New York Stock Exchange or market like that. We identify some tokens that trade on both, and we look at the ones that have small trading volume, and we end up with about 27 cross-listed tokens on both markets. And I want to show you some examples here. What this graph shows you is the blue line shows you the pricing error of Binance versus Uniswap. And so this goes with the right scale here on the right-hand side. So this is 0% here, and we have some variation here in the price. And the orange area is the pool size in Uniswap, which goes with the left scale, and that's a log scale. So we see here that initially, when the Uniswap pool was started, pricing errors were pretty big. And that's just because the pool was small at the time. And surprisingly, the pool size doesn't have to be too big to make this work efficiently. So here we have, but when the pool size is above about 700 ETH, we see that the pricing error is very close to zero. So the pricing difference between Uniswap and Binance is actually very small, which was kind of surprising for us because those markets are not too easy to arbitrage, right? So it takes a on-chain transaction to move your money out of Binance. You have to wait for Binance to process your transaction. Then you have to trade on Uniswap. And by the time the prices might have moved against you. So it's not so easy to arbitrage those two pools. And they found that prices are actually quite efficient. So this is a random day I picked out to show you this in greater detail, again on a minute by minute scale. What you see here is the throughout, this is a random day, October 21st. You see the price on Binance in blue and the price on Uniswap in orange. One kind of stylized fact that again would be a little bit consistent with this idea of the high frequency traders trying to engage this competitive niche is that the price on Binance seems to be a little bit more bouncy. So we see that Uniswap tracks the price on the limit order market, but the limit order market tends to shoot a little bit, overshoot a little bit the graph here. And we're still working on a sound econometric way to quantify that, but just the casual evidence from the graph shows is at least consistent with that idea. So what we do here is we look at the price impact on Binance versus Uniswap. So this is interesting for traders, shows you how much does the price move if you want to trade a larger quantity. The blue line is Binance, and the orange line is the empirical measure when we use the same measure that we use on Binance, when we use that same measure on Uniswap. So that's our empirical measure. But on Uniswap, we can also, because we know how the bonding curve looks and we know how much the reserves are in the pool, we can compute the theoretical price impact as well. And that's the green line that we see in this graph. So what we see is that, first of all, the price impact on Binance throughout this observation period seems to be higher than the one on Uniswap. And also, more importantly, the price impact on Binance varies a lot over time. So we have this unpredictability in price impact, which is really bad for traders because if you want to trade and you trade at a price where price impact at a time when price impact is low, it's okay. But if you want to trade and at that point in time price impact is really high, then it's really bad for you as institutional investor. So with Uniswap, we see that price impact is much more predictable and it's generally lower than on the limit order market. So this seems to be attractive for some investors. So here we look at the volume graph over time. So we look at the trading volume of the USDC ETH pair on both Binance, which is the blue line, and on Uniswap, which is the orange part. And we see that over time, Uniswap has taken over Binance as the main trading venue for this token pair. The other thing we see in this graph, which is also remarkable, is that trading volume seems pretty correlated against those two markets. So whenever there's a lot of trading on Binance, we also see a lot of trading on Uniswap, which is not that obvious, given that, again, it's not easy to arbitrage those two markets because you have to move money from the centralized exchange to the decentralized trading venue, and that requires an on-chain transaction. So we found it quite surprising that the trading volume was that highly correlated. So we have some summary statistics on price impacts and price differences between those two markets. We have performed some econometric analysis, and because I'm coming close to the end of this talk, let me just quickly point out two interesting things we see here. So obviously, when the exchange rate is more volatile, it's harder to keep the two exchanges in sync, so we see larger pricing errors. What we see here is when you look at the relative volume on Uniswap and on Binance, so we regress here on a quadratic term, which means that the pricing error is kind of U-shaped in the relative volume, which means that pricing is most close. The two exchanges have the prices closest to each other when about half the trading volume is on Uniswap and half the trading volume is on Binance. So if one exchange clearly dominates the other, that means that there is more room for pricing error, probably because the less frequented exchange is kind of not up to speed with respect to price impact. The last thing we see is that gas fees are also important. So higher pricing errors are at times and gas prices are high, and that also makes sense because then it's harder to arbitrage those two markets. So because my time is up, let me just quickly conclude. So we look at this from an economic perspective at this new model of liquidity provision in these liquidity pools. We argue that in this limit order market, which is the dominant form for financial markets today, there is this incentive to invest in this wasteful technology to carve out the competitive advantage and invest in high frequency trading. In a pool, we don't have that because these the losses when you trade with an informed trader, they're mutualized amongst the pool. And so this reduces the cost of posting liquidity, and we show both in our little theory model as well as in the data that these liquidity pools like Uniswap can actually dominate limit order markets in some circumstances. We also show that these liquidity pools can have a lower price impact and variation in price impact, and are therefore an attractive venue for large institutional traders to also be active in these markets. And that's it. Thank you very much for coming, and I'm looking forward to questions.
I do have one to start us off with really quickly. So Uniswap specifically, the V2 automated market maker was a constant product automated market maker, right? And so now with them switching to Uniswap version 3, and according to their website, it is the most flexible and efficient AMM ever designed. Do you expect for these findings to hold given the new idea and their new AMM, or is that something that's hard to theorize based off of these current findings?
It's a very interesting question. I mean, obviously there's some advantages to this that V3 has, but what we would argue is that, or what I think it is that V3 is now so complicated that I personally have not figured out yet how to be a liquidity provider on V3, right? So, and you think that you might attract a lot of the more sophisticated liquidity providers. So if I go there and I'm competing against those very sophisticated liquidity providers who have figured this all out and know exactly where to provide liquidity, where not, and how this works, and have not invested the time for my small budget that I can afford to provide liquidity, I would probably be reluctant to be a V3 liquidity provider, because I would feel that I would lose out against those more sophisticated liquidity providers. And so at least our model predicts that this more sophisticated structure has also some disadvantages that go more into the problems you see in the central limit order markets.
Okay. And then also, given the size of your data going back to November 2018, if I'm remembering correctly, have you considered kind of parsing it out into like the bottom of the bear market and then comparing it to arguably the more recent bull market that's been happening for the past couple of months, and seeing how the findings there might change given different market conditions? Or have you just kind of started with the base here of the entire data set being used as one, and this might be a potential avenue for later down the line?
I mean, for a typical finance study, the data series is still pretty short, right? Especially because the initial part where we only had V1, there's not that much activity compared to the part where there's V2. So I think it will be hard to dissect this into different subsamples, because again, we see that the tremendous growth in DeFi, and so it will be hard to say whether some effect is because of a bull market or some effect is because just DeFi grew by so much, and we just have so much more volume than we had in 2018. And so it's something we definitely would like to consider, but we haven't really figured out yet how to do that in the best possible way.
This may be completely outside the scope, since it's not decentralized, right? But one of the things that you mentioned now at the end was, how the price compares between the Binance markets and the liquidity pool, and that things actually track quite closely, even though you would expect arbitrage to be not trivial, or at least slow. How interesting is it to look at centralized liquidity pools, right? Because Binance also has the liquid swap pool, which of course is off-chain. People can transfer between the traditional markets and the liquidity pool instantly, I assume. So, I mean, is there any dates? Would it be interesting to even look at it?
I think it would be very interesting to look at PancakeSwap as well. For the most part of our sample, that PancakeSwap was not around, and so that was started fairly recently. It's big, they trade a lot, there is huge volume there. The other thing is that this is not a completely kind of free market, decentralized setup, because even the Binance Smart Chain is mostly run by Binance. So here we, in our setting, if you look at Uniswap or some pool on the Ethereum main chain, we still have kind of the free market forces at play that we are mostly interested to analyze, to see how does this really work if this develops by itself, and there's no kind of party with a vested interest that kind of dominates the chain, and that could certainly distort how things work there. That would be another interesting question if I think if Binance runs both this kind of decentralized swap market and also a centralized exchange, what are the implications for that, right? So why can they extract some extra value out of that, or what's in it for them? And so that is certainly a very interesting question.
My one other question before Trent gets to ask is so in the slide prior before the May 19 crash one, you mentioned some numbers about reversal transactions, and that there were only, I believe, 18 instances of people depositing and withdrawing from a pool large amounts rather quickly, right, within 5 blocks. Or was this surprising, or was this expected, right? I mean, because your conclusion is that people are not using this strategically. Did we expect them to? I mean, is there a lot of value to be extracted there?
But looking how often liquidity gets posted and withdrawn on traditional financial markets, on these limit order markets, it was kind of surprising, right? But on the other hand, it was from our model, it was kind of expected that because, and I think that's one of the big advantages of these design for these liquidity pools, that there's not such a strong incentive to add and withdraw liquidity. So that makes it really attractive for large traders because you know what you're gonna get, right? You know that if I want to buy, I don't know, $1 million worth of a token, I know what price I'm gonna get. And so if I want to buy $1 million worth of stocks on the New York Stock Exchange, I don't know what price I'm gonna get. I have a lot of information out there, but that by the time my trade executes, a lot of that liquidity might be gone. And because everything is in this nanosecond kind of speed race, and so I don't know what's going to happen if I place that order, and I have to go through sophisticated measures to hide my order flow and things like that. So that's something you don't need to do on Uniswap. You don't need to chop up your order into smaller pieces because you know what you're going to get. And if I want to trade $1 million or 10 million, or I just do that, and I know what my price impact is going to be.
All right. So this is kind of goes back to the chart that you were showing, the price, quote unquote, discrepancies between Uniswap markets and Binance markets, right? The little arbitrage opportunities there. Do you think, given the centralization of Binance, right? So like if I buy something on Binance or I make a trade on Binance, I'm doing it on their centralized exchange, whereas Uniswap obviously decentralized, and there might be more gas fees attributed to using Uniswap, right? So yes. If we're in a time of the market when gas fees are extremely high, are we finding there's more of an arbitrage opportunity between trade prices on Binance and Uniswap, right? Because like people may not want to make those trades on Uniswap, which might make those like mountain or peaks and valleys a little bit more smoothed out compared to Binance, where you might not have to use as much gas to make a trade, right? In theory. So is that something that might be attributing a little bit to those kind of more smooth curves for the Uniswap market prices?
Yeah, that could be one potential reason, because higher gas fees. Yeah, it's hard to say what the true price is, right? So it's hard to say whether the Binance price is the true price and Uniswap is just lagging behind, or if Uniswap is the true price and Binance is just overshooting. It's kind of hard to distinguish those two. But yes, gas prices certainly might have an effect on price differences, and we showed that actually in one of the regressions. It showed up that that higher gas fees means that the quoted prices on those two markets diverge more. Now, these are not real arbitrage opportunities, because when you do the arbitrage, you would have to pay the gas, and that makes it uneconomical to do so. And so we do see these higher differences in quoted prices in these two markets when gas fees are high. Yeah.
All right. Well, thank you so much, Alfred. Really appreciate you coming and giving a talk today. If you have suggestions for future speakers or would like to present your own research as well, please email us at research@protocol.ai. I would also like to announce that Protocol Labs Research has expanded our grant offerings to include PhD and postdoc fellowships, Young Research Awards, sabbatical grants, and a number of other awards as well. And you can check these out at grants.protocol.ai. And finally, if you're interested to receive more updates, please sign up for our mailing list and specify what types of info you would like to receive. For example, you can learn more about our grants program or receive monthly emails announcing when we have new research talks like this one that Alfred gave today. So thank you again, Alfred, really appreciate it. And we hope you had a good time presenting today.
Thank you very much for having us.